Hey everyone, me Kevin here. Boy oh boy, crashes can be depressing, and a depression is exactly what we might be facing soon. That's because this paper, back in 2006 by Mr. Robert Shiller and others over at Yale, Mr. Shiller created the Case-Shiller Index for tracking real estate, put together this piece on the stock market versus the housing market when it comes to wealth effects. Now, this is an older piece, but it has a really interesting conclusion. You can really find this just by Googling wealth effects housing versus stock market, so it's not like you really have to dig far. But that's because it's a relatively popular piece, but it's just worth mentioning the conclusion here. Take a look at this conclusion because it has really big, in my opinion, implications for what we're potentially about to face, and we just got some more numbers just this morning that are going to give us a little bit more insight into exactly the impacts we could be facing here. So when we take a look at this, what do we end up getting? Well, we get the following. We find at best weak evidence of a stock market wealth effect. So remember, folks, the Federal Reserve wants consumers to stop spending as much money. Less demand means less inflation, the economy slows down, and what happens when the economy slows down? Well, finally, people lower prices to encourage folks to buy again. That creates disinflation. Inflation goes away, and the Fed's tightening regime goes away. But the Federal Reserve will certainly know that a fall in the stock market, while it certainly feels like it hurts us, and it would make sense that there's a wealth effect of stocks going down so people are going to spend less, at least based on this research piece, stocks aren't really what have the greatest wealth effect. It's instead, and who knows, I mean, I certainly think it makes sense to spend less when your stocks go down, but you know, that's just an opinion and sort of an anecdotal piece of evidence. This is a study by Mr. Shiller and Yale and others there. And so they don't really actually see the stock market as having the largest wealth effect on individual spending. Instead, it's the housing market, which is really interesting because if we think about Jerome Powell, what was his advice to home buyers? His advice to home buyers was wait for a reset.
You know, I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels.
He said that in June. I believe it was June. It might have been May. Either way, it might have been May. When Jerome Powell tells you wait for a reset in the housing market before buying, it kind of sends you a little bit of a signal that, oh, dang, they probably know about this. The stock market going down isn't enough to bring inflation down. You have to see the housing market go down to get inflation to go down, because the housing market will actually affect inflation. Take a look at the next line that I've highlighted here in green. A 10% increase in housing wealth tends to correlate with a 1.1% increase in consumption. Opposite would then presumably be true as well. A 10% decline in housing would be a decline of 1.1% in consumption. A 10% increase in the stock market had virtually no effect on consumption. So if you are chairperson of the Federal Reserve, or if you're on the board of the Fed, you know you have to manipulate the housing market down to actually get inflation out. And one of the easiest ways to get inflation to go down via real estate is to raise interest rates, especially for the 10-year Treasury yields to skyrocket. And folks, that is exactly what's happening. Now, some of this could be because of quantitative tightening, could be because of fear of the market. It's probably a combination of both. But remember that I've said the housing market sustains permanent damage anytime the 10-year Treasury yield is over 2.75. Well, it's currently at 3.57. It's up over 8 basis points today, which is quite remarkable. And if you look at the year-to-date chart, we are at the highest levels that we have been at so far this year. We're higher than where we were at the peak in the summer. The longer we're at these levels, the more permanent damage we're going to see in real estate, the more opportunities there will be to buy real estate more cheaply, but the more the Fed will actually accomplish their goal of reducing consumer spending by destroying people's wealth, making them feel poor, making them spend less money. When they spend less money and feel poor, inflation comes down, then, quote, housing will settle in a new place, as Jerome Powell said, and we'll be back to a normal sort of equilibrium again. And that, in my opinion, is going to be the perfect opportunity to go shopping for real estate. It's why I've got a real estate startup that is looking to maximize the opportunity of buying real estate once the pain and damage comes. You can learn more about that by going to househack.com. But let's look at some housing data that's just now coming out so we can see where are we now. I mean, has housing started to turn? And what numbers came out this morning? Let's get into it. And then we get the housing numbers that we can look at so we can kind of get an idea of what the heck is going on in the housing market, at least based on numbers that came out just this morning. Keep in mind, if you want to build wealth in real estate, make sure you study now. Go through the programs on building your wealth and going from zero to millionaire in real estate as a real estate investor, learning property management, rentals, rental renovations, where to save money, how to save money, all the tips and tricks that I know with not only myself, who's been doing this as a broker for over 10 years now, but also my wife, who's a property manager, and my in-laws, who have been in the real estate industry for 30 years, actually more than that. So super excited to have you. We even have my mother-in-law in the property management course. So really incredible content for you to learn from. Take a look at those. Link down below. You could even bundle them together and use that coupon before the end of the month because the price will be going up at the end of the month as that coupon expires. So what did we get in terms of numbers? Well, folks, take a look at this. We have a little bit of an interesting gyration here that we want to understand. So first, housing starts actually moved up. Now, this is actually a very fascinating number that we had. Housing starts up as new construction rises, but we have to actually look at the details to understand, wait a minute, what really happened here for us to see sort of a bump up in housing starts? Well, when we look at the actual data, we see that a lot of the housing starts actually came from multifamily, which makes a lot of sense because rents are A, astronomically high, and B, still rising because as people are priced out of being able to purchase homes, they end up renting. And that drives pressure and more demand on rents, which causes more rental-based inflation. But it also makes it more desirable to build a multifamily building and rent it out. If you are building single-family homes, you're probably selling them. And those numbers are not looking as pretty, which makes sense because single-family homes that are built by developers are generally getting sold. This is a pretty terrible time for starting new construction on a single family, in my opinion. Now, building permits plummeted. Building permits came in down. We were expecting them to fall 4.8%, but we actually missed the economists' expectations by nearly twofold, actually more than twofold. Building permits actually fell 10%. We had a 10% decline in building permits, and it's a sign that builders are not extremely happy about what's coming to the real estate market, and it makes sense that home builder sentiment has been falling for 9 months, the longest decline ever that we have had for home builder sentiment since the start of this tracking tool. Now, if we look at the Redfin data center, we get some really fascinating things going on. But what you want to do, and I want to teach you how to do this so you could do it yourself as well, is Google Redfin Data Center. And I want you to do the following. Go to the data center, and when you're there, you're going to go ahead and uncheck 2020. You don't need 2020, so you can take 2020 out because it gives you some weird curves and lines that don't make too much sense. And what we want to do is we want to jump to median sales prices. And we can already see this about 4 to 5% moderation in median sales prices. We already see that. But what you really want to do is go to certain markets. Like, for example, let's go to Austin, Texas. So we jump over to Austin, Texas. And on a 4-week moving average, we could see some pain. And if we go to a 12-week moving average, we could see that pain smoothed out a little bit. You can make that adjustment there on the right box. Now, what's remarkable is for Austin, if we go peak to trough so far, we're going to go from a median home price of $554 to $516. It's a big drop. that actually already reflects, if we go to 516 divided by 554, that already reflects a 6.9% drop in Austin, Texas real estate prices. It shows that we've peaked in roughly April. If I now go to the 4-week, you'll actually get a little bit more of a sinister look because the latest data over here on the right isn't actually smoothed out all the way. And if you look at the latest data, you'll see that the median sales price is coming in at $498. And so now if I divide by 498, the most recent closings are actually showing that real estate in Austin is potentially down already as much as 10%. And you could do this in remarkably any area that you want. For example, if we go to Boise, Idaho, and plop this in here, and we go on to the 4-week, which takes more into account the last 4 weeks, right? It's not smoothed out over 3 months. We see a move down from 547 to 494. 494 is the new number, and the old number was, what did we say? 547. So take the new number divided by the old number, 547, equals also about a 9.7% decline. You can do this relatively for any market, but folks, the peak is clearly behind us. This is why I sold my real estate in mostly Q1 of 2022 this year, because I believe that was the peak. And I like to buy low, sell high. And that's exactly what we'll be doing at HouseHack. If you want to learn more about how I buy wedge deals to protect myself and make sure that I'm insulating myself, check out the programs on Building Your Wealth down below, especially those real estate ones. And check out HouseHack if you're an accredited investor. The first investing deadline is September 30th, which is in 10 days. And that's when we start seeing warrants expire if you have not wired funds yet by September 30th. So take a look at that by going to househack.com. Thanks so much. Goodbye.